Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. We've got a really complex and dense stack of source material this morning. We're pulling key threads from CNBC, Bloomberg, Reuters, and Yahoo Finance. Our deep dive mission today is pretty crucial, actually. We need to stitch together these two massive forces that seem separate but are fundamentally linked. They're really driving market volatility right now. So on one side, you've got this accelerating huge investment in AI compute power. It's reshaping physical infrastructure, And on the other side, well, there's the increasingly complex, volatile geopolitical landscape. It's suddenly shaping corporate strategy, often disrupting it. We're going to show you how these massive tech leaps, like Apple making advanced servers right here in the US, are happening right alongside these sudden political shocks. Think about Trump abruptly ending trade talks with Canada. It's quite the mix.
It really is a critical convergence point. And the timing of this deep dive, this Friday, October 24th, 2025, it's key. There's just maximum uncertainty everywhere you look. I mean, the CPI data we're all waiting for this morning, that's essentially the only major economic reading the market has right now because of the ongoing government shutdown data vacuum. So every single headline gets amplified. Synthesizing these diverse stories like we're doing now, it's absolutely vital if you want to understand the underlying forces shaking the markets.
Okay, let's unpack this. Let's start with the foundation, the AI infrastructure, the physical chips, the data centers, the sheer capital needed to power this boom. And it seems to be moving domestic, right? At a massive scale. CNBC's reporting shows Apple has actually started shipping advanced AI servers from a factory right in Houston, Texas.
Yeah, and that's huge. It's symbolic, but also very material. It's part of Apple's very large commitment, what was it, $600 billion to spend in the U.S. on advanced manufacturing and suppliers? But strategically, it's more than just fulfilling a promise, right? These servers aren't just general purpose. They're specifically designed to power Apple's own things. Apple Intelligence, their private cloud compute, and crucially, they use Apple's own custom silicon.
And what really jumped out at me from the reporting, Apple's COO Savi Khan said this Houston factory, which took over work previously done overseas, is already up and running ahead of schedule. That's not just about jobs, is it? It feels like it's about controlling that entire tech stack, chip design, hardware, the services, everything.
Absolutely. That's vertical integration playing out right there.
Yeah.
But okay, if Apple is building the servers, what about the sheer processing power needed to train the huge models these servers will run? Bloomberg and CNBC detailed this staggering cloud partnership between Google and Anthropic. This deal gives Anthropic access to, get this, up to 1 million of Google's custom tensor processing units, TPUs.
1 million TPUs. Okay, that sounds massive. But beyond just the big number, what does that actually translate to in terms of real investment, real infrastructure?
We are talking well over a gigawatt of dedicated AI compute capacity. That's scheduled to come online by 2026. And the financial context here is key. Industry estimates suggest a 1 gigawatt data center costs around $50 billion to build, and maybe $35 billion of that is just for the chips. So this deal really cements Google's position. They're not just competing in the AI model race. They are now like an indispensable massive infrastructure provider for this whole ecosystem.
Okay, but that raises a question for me. Anthropic's using Google's TPUs, sure, but the sources mentioned they're specifically going for a multi-cloud strategy. Aren't they just swapping vendor lock-in risk for like huge integration complexity? I mean, switching between TPUs, Amazon's Trainium, NVIDIA GPUs, the optimization cost must be immense. That's a perfect point to raise. And yes, they absolutely are increasing engineering complexity, no doubt. However, look at their revenue run rate rapidly approaching $7 billion annually. And that kind of suggests the strategy is worth the cost, right? The strategic advantage of that multi-cloud approach is resilience and also fine-tuning. Anthropic apparently wasn't impacted by that recent AWS outage. So it kind of confirms this diversified architecture is, well, a cutting-edge way to manage this exploding compute demand and keep things running no matter which vendor has a hiccup.
It's clear this massive private AI investment is moving the needle domestically. But is this just a private sector thing, or is the government actively, shaping the field? Intel's latest earnings report gives us a really fascinating answer here, linking right back to that infrastructure theme.
Absolutely. So Intel reported Q3 revenue that beat expectations, $13.65 billion versus the $13.14 billion estimate from LSEG. It signals a recovery in PC processor demand, and yet the stock jumped quite a bit in pre-market trading. That's according to CNBC and Yahoo Finance.
Okay, sounds like a standard earnings beat. But here's where it gets interesting, right? This is Intel's first report since the U.S. government took that significant 10% stake back in August. And President Trump has reportedly suggested the government's already made, what, $30 to $40 billion on that initial investment?
Well, yeah, and what's fascinating is how that government stake immediately messes with the bookkeeping. Intel had to report a technical loss 37 cents per share for the quarter. Now, this wasn't bad operations. It was purely to account for the shares held in escrow from that $8.9 billion government investment. It's this direct financial blending of state and corporate interests. Pretty unprecedented scale. And they're still waiting for SEC approval on how they're accounting for it, which, is complicated by the government shutdown still going on.
And it's not just direct investment. We're seeing regulatory power being used to directly speed things up for the AI sector's physical needs. Bloomberg reported that U.S. Energy Secretary Chris Wright urged FERC, that's the energy regulator, to grant expedited reviews for data center power grid connections.
Yeah, this is potentially a huge regulatory shift. It's designed to just cut through the red tape. They're drafting a rule that proposes limiting those critical utility reviews to just 60 days. Currently, that process can take years, literally years, blocking new data centers. The rationale seems pretty clear. Rapidly scale up the energy supply for this power-hungry AI industry and deliver on the president's AI goals. So the government is actively trying to make sure the power grid can keep up with the compute demand we were just talking about.
So if you connect those dots, state investment in a key chipmaker like Intel, faster regulatory approvals for power grids to fuel AI, and this domestic server manufacturing push from Apple, we're definitely seeing what CNBC's analysis called a highly coordinated U.S. economic plan with a twist. Okay, now let's pivot sharply. The U.S. might be trying to build up these domestic compute fortresses, but that whole effort is constantly being challenged by geopolitical volatility outside those walls. Let's look at the highest stakes global standoff right now, the upcoming Trump-Xi meeting.
Right, so that meeting's confirmed for next Thursday on the sidelines of the APEC summit in South Korea. And leading up to it, we are seeing China strike a much more conciliatory tone. According to CNBC and Bloomberg, Commerce Minister Wang Wentao is opposing decoupling, seeking the right path for getting along.
Yeah.
But, that public talk often masks these really deep strategic tensions underneath.
Given that softer tone, though, does that mean pushing for specific concessions is less likely to work? What are the key things Trump is actually prioritizing in that meeting?
Well, the report suggests Trump is looking for quick, measurable wins. Things like resuming American soybean purchases, cracking down harder on fentanyl exports, and crucially, getting Beijing to back off on restrictions for rare earth exports. However, experts highlighted in Bloomberg suggest China sees rare earth dominance as its most critical strategic lever. So Beijing is highly unlikely to give ground there without major U.S. compromises on tech sanctions. It's a diplomatic dance right now, but the core positions seem pretty rigid.
Speaking of volatility, trade relations with Canada just hit a total wall this week, didn't they? Trump abruptly terminated all U.S. trade negotiations.
Yeah, that was a real shocker. Just sudden, unexpected, as reported by CNBC. The official reason Trump cited was an ad aired by the Ontario provincial government. It featured an edited clip of former President Ronald Reagan criticizing tariffs. Trump called the ad fake E, claimed it was meant to interfere with a pending U.S. Supreme Court case on tariffs. It just highlights how market stability can get completely derailed by these almost theatrical political gestures. And that instability hits sectors relying on USMCA right away, even if the trigger is an old Reagan clip.
And adding to this global instability, we've got sanctions driving significant disruption in the energy market, which of course feeds directly into the inflation figures we need to talk about next.
Correct. The U.S. sanctioned major Russian oil producers, Rosneft and Lukoil. That move immediately jolted global crude prices. Bloomberg reported Brent crude jumped 7% for the week, trading near $66 a barrel. And to make things more complex, Chinese state-owned refiners like Sinopec paused buying some Russian seaborne crude, the ESPO grade. Just another layer of geopolitical disruption hitting the oil market.
Okay, now let's really focus on the critical market watch for today. Everyone is waiting for that delayed September inflation report, the CPI. Due out 8:30 a.m. Eastern this morning.
Yeah, this CPI report, held up by the shutdown, is basically the market's entire focus right now. It's like driving on a highway where someone just removed the only speed limit sign. Economists are generally expecting a 0.4% month-over-month increase. That would push the 12-month headline and core inflation rates up to 3.1%. But the lack of other official economic data means any slight surprise here, up or down, could cause a really outsized, exaggerated market reaction.
And what's complicating the outlook here is what analysts are saying about trade policy, right? Tariffs seem to be a big factor.
That's right. Analysts from Bank of America and Goldman Sachs, cited in Yahoo Finance and CNBC, believe tariffs are a key source of inflation and goods prices, and they project this upward pressure. It'll likely continue through the first quarter of 2026. That's crucial. It means policy decisions being made now, like tariffs, are expected to show up in the inflation pipeline for potentially 2 more years.
Right. Yet, despite this inflation cloud hanging over everything, U.S. stocks have actually been moving up. The S&P 500 is incredibly close to a new high, just more 0.39% away as of yesterday's close. Asia was strong too. South Korea's Kospi hit a record high, partly boosted by that Trump-Xi meeting confirmation, it seems.
And earnings definitely provided a lift. We saw the Swedish defense group Saab upgrade its 2025 sales guidance, projecting a huge 20% to 24% increase, deriding that European defense spending boom. NatWest also beat profit expectations, 2.18 billion pre-tax. And the luxury group Kering saw its shares pop almost 9% after their strong earnings report, too.
But it's not all positive on the earnings front, is it? The huge demand for AI infrastructure seems to be creating this ripple effect, almost like an invisible tax on consumer electronics.
Indeed. Reuters reported that the Chinese smartphone maker Xiaomi is facing significant cost pressures. Why? Surging memory chip prices. And critically, those memory prices are being driven up by the global rush for AI chips. This pressure forced them to price their new Redmi K90 series higher than maybe the market wanted, leading to some disappointment. It's a perfect example of how the AI infrastructure demand we talked about at the start is having this direct, cost-raising impact on everyday consumer tech. So look, we've just navigated through a really high-velocity environment. You've got unprecedented tech investment, escalating global trade fights, and critical inflation worries all peaking at the same time. By synthesizing all these facts from the sources, you should now have a pretty comprehensive map of the key forces shaping today's financial headlines.
Absolutely. And that leaves us with one provocative thought to mull over this weekend, especially as the market digests that CPI number. Given that the U.S. government is actively pushing to speed up data center infrastructure and Apple is seriously ramping up American-made AI server production, how quickly can U.S. domestic supply chains actually meet the kind of exploding compute demand generated by deals like that massive Google Anthropic partnership? Something to think about. We'll see you all Monday morning with new headlines from major financial magazines.